Well, we've been talking about what you do when you pay off your car. What do you do with that surplus cash flow that used to go towards your car repayments? Now, Gavin, once you've paid off the car, you might have been the sort of person who, lives fairly close to the bone, not a lot of spare cash, but all of a sudden you find yourself in the situation where you've got a bit of spare cash. Does that put you in the realm of being a person who perhaps is ready to become an investor? Because sometimes you need that extra spare cash to think about how you might invest. What is a good definition for an investor? Is it a person who's just got millions, or are we all investors if we've got a few dollars spare?
Yes, I think we're all investors when it comes down to it, and it's just a matter of how much we're going to invest, really. For that person who's a bit close to the bone and has created some surplus cash flow because they've paid off their car loan, they can start to invest and use that money wisely to achieve what they want to in life.
Okay, well, let's talk about being an investor. If you did have, and now look, it's going to be different for every car. Let's say your car repayments were somewhere around $100 per week. That might be high for some, it might be low for others. Maybe if you're coming out of a lease arrangement, you could have been paying hundreds of dollars a week, but if you've got that spare $100 a week, what's the best way to look to invest and to grow that level of $100 a week into something substantial?
Yes, so we've touched on the key to creating wealth here, which is spending less than you earn. We're now spending less than we earn. We've got $100 a week to put aside to invest. The key we can go back to those concepts of paying down any consumer debt and credit cards, car loans, other debt. The first question we need to ask is, what structure are we going to invest in? Are we going to invest in your own name, a joint name, in a trust, a company, in super, or through a first home saver account, for example? So the first thing to decide is, what structure will I invest in? And often the simplest with $100 is to invest in your own name in a high yielding bank account and accumulate several $1,000s, and then you can start to think about doing something more interesting.
Interesting, the name of your business, and we always make reference to it. It's Cornerstone Wealth. People come to talk to you because they're interested in structuring the management of their finances so that they can create some level of wealth. If you've got that spare few dollars to make a start, what do you normally say to people who are not necessarily super wealthy, but they've got to make a start and they've got to change their thinking about the way they deal with money?
Yeah, the key is to create that surplus first, and then once they've got to that point in time, I encourage them, particularly if they're a young person, but even if they're a bit later in life, to start the journey of investing. And one of the key fundamentals to investing is to not lose money as your first starting point. And then the second thing is to diversify. So the sooner you can balance out your investments across a broad range of investments, you reduce risk without necessarily reducing your return. So there are mechanisms when you just have, say, a few $1,000s to invest, where you can invest in a very diversified way. And listed investment companies are a good way to start, like Australian Foundation Investment Company or Argo, or there are a lot more listed, what we call exchange traded funds, which effectively enable you to invest in a very broad range of investments across the whole gamut of both Australian and international markets. So you can invest through those mechanisms as well to diversify away some of your risk without foregoing return. A little comment here on companies that are well known, because sometimes there are companies spending a lot of money to become well known. They get their name up in lights, and we feel more comfortable because we feel like there is a sense in which that's a trustworthy company to invest in, or to put some dollars into for an investment. But there's others, you've mentioned some that perhaps some of us have never heard of before, that are less known but actually have wonderful returns for investors. Yes, you've hit on a really interesting point, Neil. And there is a couple of gentlemen, Ken French and Eugene Farmer, who through the Chicago Business School researched where return came from. And you've hit on one of the indicators of return, and one of those is being a large stock versus a large stock versus a small stock is a big indicator of the level of return. Because if you look at, for example, a BHP, if they go to the bank and borrow some money, the bank is going to give them a very favourable rate because they're big and they're well known and they've got credibility. If they go to the corner store, if the corner store goes to the bank and wants to borrow some money, they're small, a little bit more risky, and so the bank is going to charge them a higher rate of interest, and therefore that you need to get a higher level of return to make that worthwhile. And so you've hit the nail on the head. Those companies that we know, that we're familiar with, the banks and BHP and Rio, Woolworths and Wesfarmers, all those well-known companies, they're large and they have a more potential stable return, but they're generally lower than the smaller companies as well. So you've hit on one of the indicators of return.
So you've got to do some of your own research to find out who is or which companies might give you a better return than the ones that are perhaps well known.
Yeah, exactly. And so one of the indicators is how large they are. One of the other indicators is whether they're called a value company and or a growth company. And so the way that you can define that is, if you're a value company, the value of your shares, so the number of shares times what the share's worth, so 100 shares, and if they're worth $10, the valuation of that company is $1,000. But if the assets that the business holds, whether that's plant and equipment, if that's worth roughly the same amount, it's a value company. If it's quite different, if the assets that the company own is worth, for example, $1,000, but the shares of the whole company worth $4,000, that's more likely to be a growth company. And so there's more potential for higher earnings within a value company, but there's higher risk as well.
Now, Gavin, where do you go to do some sound research when it comes to how you might invest your few spare dollars? Are there particular places that people can look?
Yeah, there's lots of information out there. So if you're wanting to get into the nitty-gritty, you can start learning about investing by reading there's a plethora of books out there. There's a lot of information available about individual companies and stocks, either via online traders, or you can get personal service through the likes of stockbrokers, but you really need to step back and think, is this something that I want to do, and is it something that I'm going to enjoy putting the time into? Many people do enjoy it, but you just need to understand, are you the personality that's going to want to do this over the long term? Because it might be interesting getting into the investing and buying some investments, but the next question is how long you hold them for and when you should sell them. They're probably harder questions than the actual investment at the start.
Well, Gavin, it's always good talking, and I should say that the advice we're talking about when it comes to finance and investment is of a general nature, and you should see your personal financial advisor to take your personal details into consideration. Gavin Martin from Cornerstone Wealth. And yes, you can go to Cornerstone Wealth and you can check out those things that Gavin has on offer too. He's not a sponsor of the station. He's been our long-time guest. And Gavin, it's always a pleasure. Thanks so much for being with us today on 2020.
Oh, thanks very much, Neil. Great to be with you.